Hello, everyone. Thank you for joining today's web conference, our CNR 2024 January market update. I'm Charles Luke, City National's Chief Investment Officer, and I'm joined by some key leaders from our CNR investment strategy team. We've got Michael Taila, our head of fixed income, on with us, and Paul Single, our senior economist. So everything you're going to hear from us today is sourced from our investment committee's monthly meetings, and certainly there's a lot to address. We're just in the second week of the new administration, and the market has experienced its first large pullback of the year on Monday. And before we get there, just as a reminder, at the end of the presentation, we're all going to be on the line to answer any questions we receive from you during the webinar, so feel free to type them into your Q&A window anytime during the session. If you're interested in the PowerPoint deck, you can also download the presentation materials using the resources window on the right side of your console. So let's go ahead and get started. So as many of you know and you've seen, we have our speedometers. These are 20 different indicators that influence economic activity, and we score those on a 1 to 10 scale. So for reference, anything that's in the red zone is a potential negative for economic growth. Yellow is normal, so there's really no acceleration or deceleration, and then green is positive for the growth environment. So after having about 2 months of no changes prior to the election, we did have 2 changes for our February review. So if you look at what's highlighted here in the first black box in the first row, the U.S. economic outlook has shifted into the green zone. So Paul's going to talk a lot about this, but if you think about job growth, income growth, moderating inflation still on an okay trajectory there, productivity results, earnings, and the pro-business policy outlook really support the economy. And then the other change that we made was in energy. So this has been a big topic over the past couple of weeks, but we've recently moved that to the middle of the range in yellow, and we did make another shift this week for the February changes. So I think it's clear that the Trump administration does want lower oil prices, and they want to see commensurate increases in production. So that's a positive for energy security, and it's also a positive for inflation in terms of those pressures. And then if we think about his address at Davos, he did call on Saudi Arabia and OPEC to reduce prices directly in order to hurt Russia's profitability from selling oil. So if we think about the combination of those factors, we don't think energy prices at this point are an impediment to economic growth. And we think the current outlook is supportive of where we see things going. So some of the additional indicators that we're closely watching include yield curve shape. So Mike's going to discuss a lot about that. Interest rates broadly and the impact. Certainly geopolitical risk. I'll address the Israel-Hamas ceasefire a little bit later and further into the presentation. And then, of course, we have the DeepSeek situation with AI and technology, which we'll also talk through. And then, of course, inflation, which we still have heavily in the green zone. But the underlying message from our speedometers remains that growth is on a solid trajectory. The economy is healthy and corporate profits are growing. So we have some uncertainty from policy implications, but it still leans overall toward an improving climate for business. If we parlay that into our forecasts, we do remain positive on growth. So taking a look at GDP, we did shift our expectation to about 2 to 2.5%, and that does reflect the continued elevated growth rates in 2024 that we saw, moving at about a 2.5% pace after the number today. That's a strong tailwind for the economy. And then when we look at concurrent measures, something like GDP now, that's a more real-time measure of growth. It's north of about 3% for the current quarter. So growth still looks to be moving along quite nicely. If we think about the next line, so corporate profits, they have fallen from recent highs in terms of expectations. They were previously running around 15%, but they're now down around 12.4 on a calendar basis. So that's still 2% over the 2024 consensus right now. So we discussed our forecast last time based on potential tax extensions and possible cuts, sort of placing the trading range for the S&P 500 between 5,800 to 6,400. We now see the potential to end the year on the S&P between 6,400 and 6,500. So I'll go through those numbers in the equity section today, but generally earnings to us look to be in good shape. And as tech faltered even a little bit on Monday, the market is continuing to broaden out. So if we move to inflation, this week we will get some additional information on inflation by way of the personal consumption expenditure data, which you may have heard called PCE. We also have the Consumer Price Index, or CPI, and that was a little elevated in the report for January. When removing the impact of food and energy, it did come below expectations, advancing at about a 2.9% annual pace. The month-over-month numbers there are a little elevated. Paul's going to have a slide on that. They climbed about 0.4%, but we continue to believe it's still too early to become extremely worried about a substantial rise in inflation. And my main question here is if growth remains supported by the new administration's policy and inflation remains stable or even moves slightly higher, is that an acceptable trade-off for growth? And so at this point, I do think it is, but it's really hard to tell until we get some more data over the next couple of months. So again, Paul's going to talk a little bit about inflation expectations. That has caught our eye a little bit. Those numbers are edging up. But we do think as growth continues to normalize, we expect inflation to be somewhere between 2.5% to 2.75% by the end of 2025. So we don't see it falling back to the Fed's target, but we do believe the market can handle it. And then moving into rates, certainly we've had continued volatility here. We had the Fed meeting yesterday. Powell did say that the Fed will hold interest rates steady for the foreseeable future, and that's due to uncertainty over Trump policy. He did note the strong performance of the U.S. economy and stability in the labor market to allow the Fed to hold off on additional rate cuts for now. Essentially, they're not in a hurry. So on inflation, the Fed did want to see further declines in price pressure and what they called serial readings. So many different readings going into the future that would suggest continued progress on the inflation front. And again, Paul's going to discuss this in more depth as well during his section. But even in September, with respect to the Fed, we did believe this to be the case. So we never budged below our 3.75 to 4.25 range on Fed funds. And we consistently stated that we only saw about 1 to 2 cuts this year. So Powell did note that he felt that rates were still heavily above neutral, and that's the rate at which the Fed's target should be in the long run. But the urgency around rate cuts has certainly subsided. So if we move to the 10-year Treasury, we also believe that longer-term rates are going to remain a bit higher. And so although we lowered our range in the fourth quarter of last year, we're still over consensus. So the math here is really clear. If the Fed only cuts 1 to 2 times, then longer-term rates do have to stay above 4% for the curve to remain upward sloping, indicating good economic activity. So with the economy where it is, we do think that's likely. So for this time around, we did move our range back up to 4 to 4.5. And that's essentially where we are or where we were most of last year. So right now, if we look at the 10-year Treasury, it's trading around 4.54. I think it's fallen a little bit today, but depending on policy, this could fall further in the near term, and we definitely think so by the end of the year. This will be heavily dependent on policy and expectations. It should take a little bit of time for the market to gain more confidence around the long-term impact. And I also wanted to go back through on slide 5 here some of our global market themes. So we broadly funneled the themes into 4 different categories. So we've got Trump policy, so Bitcoin, digital currency, deregulation, and then really zeroing in on tariffs and immigration. So if we look at those combined and the pressures that those can create, we think that's going to continue to filter into the market over the year. And then we're looking at impacts to deficits and overall debt, which we'll discuss as well. Then it's geopolitical tension. So I've got a slide on this in just a little bit, but the last time we met, we'd just come off the fall of Assad's regime in Syria. Now we're just meeting after a ceasefire was reached in the Israel-Hamas conflict. So the developments right now have been somewhat positive. But is this due in part to the transition to Trump? Possibly, but I think we still have 2 major issues out there, definitely relations with China and Russia-Ukraine, which will continue to be a focus of the market. And then we also have some strange issues out there like the Greenland situation and the potential annexing there strategically that Trump is talking about. I don't think that's something that's going to happen, but we're going to see that type of volatility enter the market. So this is going to continue to be a huge factor contributing to our outlook and the stability of the market going forward. The third theme is in AI. So we've talked about the second and third waves being underway and filtering through the economy. We still think that's the case. So away from tech companies and into other sectors like industrials, utilities, and anything that's going to have a tangential impact from that. So we're still in the adoption phase. We've got infrastructure, power and energy, software, enterprise to really start adopting that. So it's going to continue to work its way through. And that will continue to drive a lot of the tech earnings, although we do believe that earnings will come down to around 15% for the Mag 7 on average. And then we've got DeepSeek. So that's a new element that was introduced this week, and that's created a bit of a rethink around AI development. And we'll go through that in just a second. The fourth theme is equity market valuation. So if we think about the market on a scale of 0 to 100, 0 being the lowest valuation, 100 being the highest valuation, we're basically at about an 85% level statistically. So nevertheless, on that side of things, I think valuation can be a trap. And I'll show you later that there is a loose correlation between valuation and short-term returns. but it doesn't mean that stocks should go down. And then I think the concept of US exceptionalism, flows into US markets, and a strong dollar all support the level of valuation in our minds today as an investment team. That being said, we do think returns will be lower in 2025 relative to the 25% plus returns we've seen in 23 and 24. So let's shift into DeepSeek. So if you haven't been following the news or don't know what I'm saying when I talk about DeepSeek, just real quick, it's a Chinese upstart, and it's basically an AI model developer, and it spooked markets on Monday. So some of the key pieces of that are that it's an open source model, which means the code can be accessible by anyone out there. And there are reports that it costs just under $6 million to develop. You think about how much has been plowed into things like OpenAI, Google's AI, it's been much larger than 6 million. So we're a little skeptical of that, but those are the numbers that are being flown around. And then it allegedly requires a lower energy amount to actually support the engine. And so on a site maintained by the UC Berkeley Skylab, and that's in partnership with an entity called the Large Model System, the actual performance of DeepSeek's model is in third, just behind OpenAI and Google. So it was pretty significant. And as we all saw in the returns, mega cap stocks have been trading pretty heavily on AI infrastructure, and the spending is huge. So if you look at that left-hand chart on the bottom, you can see just how much it's ramped up between these big five: Microsoft, Amazon, Oracle, Google, and Meta. So naturally, it's calling into question the sustainability and the necessity of the spending that we've seen. But I do think there are three reasons that the market stabilized after this news. So the first is the need for faster and more capable computing power. That's been the norm forever. Moore's law, essentially saying that it's going to double every few years. So cutting edge chips are going to be needed in the near future, and certainly over the long term. So that means things like global data center share of the energy consumption is going to keep rising. Maybe it does slow a little bit, but it's still likely to become about 10% of global electricity demand by 2030. Put another way, older chips still need data centers. Those data centers still need cooling, and cooling takes a lot of power. Second, I think there's a misconception. While it's expensive to train the models, what DeepSeek does is it seems to lower that cost. It still doesn't say anything about the cost to actually run the models, and that's unaffected by the DeepSeek development. And then last, I think there are implications here for US-China. So there is talk about whether or not DeepSeek illegally obtained a large amount of data from OpenAI and used it to develop part of their R1 model. So could the US potentially ban DeepSeek if unauthorized activity occurred? I think that's definitely something that's going to come into view. And then what about its open source development being freely available? Will that need to be regulated? So if we think about the implications to market, I think it's going to be hard for chip companies to break through to all-time highs based on what's happened here. So I don't think we're going to see an initial bounce back immediately. Definitely created too much doubt. But we still think there's momentum out there for tech overall, and I'll discuss this more in the equity section. But as we've been saying all along, returns are going to moderate in tech. So this may have accelerated that a little bit, but I still wouldn't want to be short tech names. And also, this didn't spill over into the rest of the market. So most sectors outside of tech were actually up on Monday. And if you look at multi-cap, more stocks actually rose than fell on Monday. And I'll end this section just with what Microsoft CEO Satya Nadella said on X, formerly Twitter, this past Monday. But he talked about Jevons paradox, which means the more efficient something is, the more it is consumed, the more it's used. So as AI gets more efficient and accessible, we are going to see its use skyrocket, and it's turning into a commodity that we really just can't get enough of. So I like that quote in the way that Satya Nadella put it. So if we shift into the next big topic, really Trump executive orders, what's going on with all these executive orders and what's the administration been up to? So far there have been about 60 executive actions. Some have a direct economic impact. Others have a social impact, others have an impact to defense, and there's quite a bit of different areas that are being impacted here. So I do think there are likely to be some challenges in the courts, but what I'm surprised by is that we haven't seen more reports on court challenges. So that could be the speed of the actions, or it could be the Democratic Party is basically essentially picking their battles against a lot of what's being done. But if we go back to our framework pre-election, our main focus for the economy and markets was taxes, tariffs, trade, deregulation, and immigration. And all of those have some direct effects to the outlook, and we've seen them pop up in different areas of these actions. So I think so far, the biggest surprise is that other than a spat with Colombia, Tariffs haven't been a part of the executive action slate. We do think they're coming, but to what degree is still highly debatable. I think it's actually become a little bit of a better environment for expectations for the tariff impact and what will happen, but we're still just going to have to see what comes through. What we have seen in the executive actions has been immigration reform, trade policy through the America First Trade Policy Executive Order. That doesn't establish explicit tariffs, but it does say to review trade agreements, to buy American, and to emphasize trade laws to prevent unfair practices. So again, no tariffs, but definitely some trade policy attention. And then energy policy and digital currencies have certainly been impacted by this as well. So we're still uncovering exactly what each one of these is going to do. We're likely to see more, but it is hitting the areas that we felt were important pre-election. And the next thing I wanted to go through was just the geopolitical landscape. So let's talk about trade policy to enforce the objectives of the administration first. So we've basically seen tariff policy, trade policy almost weaponized, especially with what happened in Colombia, where essentially we had 2 planes from the US that were carrying deported immigrants. They weren't allowed to initially land in Colombia. When Trump threatened tariffs at about a 25% level, the planes were allowed to land. So that means, especially with respect to the China situation and other areas, that tariffs can be used as a negotiating tool, and they can be used to reach the objectives that the administration has. So I think that's going to be a major theme on the geopolitical side as we move forward. The second thing to really take a look at here is the Russia-Ukraine front. So Trump has made it an explicit goal to lower oil prices, which would starve Russia out of capital to continue the war effort. And he's even called on Saudi Arabia and OPEC to lower prices. So we don't know what the final impact will be on exploration and production companies here in the US. And much of the new places to drill are in deep water, which does make it a little bit more expensive. So there are multiple competing factors on that front, but it definitely is an objective of the administration to bring Russia and Ukraine to the bargaining table. And then there's also been more development since we last talked about the Middle East. So I mentioned the Israel-Hamas ceasefire, and that has effectively stopped the fighting in Gaza. That's had troop withdrawals, and prisoner swaps are really the biggest components of that deal. But we also know that it's likely to see the Trump maximum pressure sort of 2.0 that they applied on Iran 2016 to 2020. That does appear likely to return. So there are going to be a lot of mixing factors here. But ultimately, I would say that the geopolitical situation at this time does feel like it's getting a little bit better. And at least there's hope for it to be better. So more than we've seen in a bit of time. But I think the reality is, and we saw this with the Assad regime in Syria, that anything could flare up at any time. So just to sum up everything, the economy here does remain very strong. GDP is likely to remain above potential. And we do think that corporate profits are poised to continue climbing. And we have some good results so far for Q4 of 2024. We also think that current interest rate levels may be a bit extended, a little bit too high. So Mike will talk about some of our views there. But I think at these levels, we think that's going to drift back into the 4 to 4.5% range. We talked about DeepSeek and their R1 model. So it definitely is a disruptor. It's challenging some of these views on AI. But we don't think that it's likely to alter the long-term demand for computing power. And then, of course, Trump's executive actions are going to have a direct impact on the economic environment. We're especially going to see that today on immigration, trade, energy, and digital currency. And then we think about the Middle East. We do have some positive developments, but we think that the core of this, where risks really remain, is in the U.S.-China relations. So I'm going to stop there. I'll swing back on the stock section, but I'll pass it off to Paul for econ.
Great. Thanks so much, Charles. And Charles brings up some really, really important points in terms of what the outlook looks like for the U.S. economy. One, in terms of the number of executive orders that the president has already signed, will be very transformative in terms of how the federal government works, in terms of taxes, the tools regarding tariffs, and of course, immigration. So that can change the outlook of the economy significantly. And then the whole conversation about AI, I think that brings forward, and people need to really start thinking about how transformative that will be to business in the aspect that it will increase productivity significantly. I mean, we've seen things in the past, anything from how the steam shovel replaced many laborers, how the spreadsheet changed Wall Street. This will be a very, very big deal. And it just reminds me of the famous quote that, sometimes there are weeks when decades of history actually happen. And this might be that sort of situation in terms of the news release on AI and in terms of what the president is doing. That quote, of course, is Vladimir Lenin. I don't tend to quote Marxists very often, but there you go. So let's just take a look in terms of the U.S. economy and just get some background. The chart here on the left, the columns are the quarterly change in GDP, and it's updated with today's number, and the line is the year-over-year change. The yellow line, that's the Fed's view in terms of what level of economic growth is ideal so that we get continued growth in labor, but inflation stays stable around 2%. And as you can see, the economy continues to do quite well and is above that level. Today's GDP number that came out that showed solid growth. It was driven by another burst in consumer spending, especially with durable goods. Clearly, people were rushing to buy expensive durable goods before the possibility of tariffs would kick in. On the right-hand side is just a reminder of how strong this economy has performed since the end of the pandemic compared to that of our major trading partners. It's head and shoulders above those levels, almost a third, almost 3 times as much as what those countries have been growing. And it's really as a result of the fact that we have a very low unemployment rate. We have high profitability, which has driven wealth in terms of housing values and stocks, and households have deleveraged significantly. And that's a very strong position to be in because as we go through the uncertainty over this year and next year, the economy has very good grounding in terms of the ability to continue to grow. Now, tariffs, of course, are the big news, as Charles was talking about. And there's what's called the 3 R's of, or actually 4 R's now, of tariffs. One is it's a revenue stream. And for most of the history of this country, up until the Depression, that was the major source of revenue for the federal government. It also works well for restriction. By putting tariffs on certain imported products, it can help protect an awful lot of domestic businesses. And we saw the Biden administration put that on, especially with green technology. It's used for reciprocity, which is also very good in terms of negotiating trade deals. Be happy to reduce tariffs to import some of your products if you buy our products. And the president plans to use it for that. And of course, retaliation. The president used that this past weekend, as Charles talked about, with regards to Colombia. But there are other economic aspects to that, and it all depends on how they're implemented. Will it be a one and done situation? Will it be like a 10% tariff on everything that's put in place? Well, that would cause a jump in inflation, but after a year, the year-over-year number won't show that anymore, so the Fed will probably see through that. But if tariffs are fed in over a period of time and prices move up and move up and move up, then that may change how consumers look at inflation in terms of the future. Then it may push up those numbers, and that's where the Fed is concerned. Please bear with me on the chart on the left. You got to squint a little bit, but there's a reason why it's set up this way. This is showing consumer expectations for either the next year, which is in light blue. You can see how that spiked in 2022 when inflation went up, but it's since retreated mostly. But the dark blue line is a longer term view, and this is a bigger concern for the Fed. This is a view from 5 to 10 years out into the future. Although the light blue line, the year over one, jumped a 0.5 percentage point this past month, the fact that the longer term view is now at a level that we haven't seen since 2011 is worrisome to the Fed. Because if consumers start thinking they're going to be paying higher and higher in prices, that alters their behavior significantly. Also, not only are tariffs inflationary, you have the risk of a trade war, and that's been a bigger issue for the growth of the economy, and we'll just have to see how that plays out. Now, the chart on the right is just sort of an idea of how this may alter people's behavior in terms of their spending. This is the outlook in terms of what people think in terms of their buying for durable goods. It had jumped up in the fourth quarter, again, because people were buying an awful lot of products before the risk of a tariff, but it turned down a little bit this last month. It's not a strong reading, but it is something that we'll be paying attention to in terms of whether consumers will be looking differently at products and whether they want to buy them or not. Because durable goods are the expensive ones, and that drives a big part of consumption. In regards to inflation, on the left-hand side here, you can see the consumer price index. Once the Fed started raising interest rates, inflation started to come down, stabilized, came down a little bit, and it's moved up a little bit. So the deflationary trend is not there. We still are very confident that the Fed will be able to get inflation down to 2%. The big driving forces is, of course, shelter prices or housing costs. And the way that they calculate that is based on a quarterly number that was just released this past week. And that shows that shelter costs are actually coming down quite a bit. And that's a leading indicator for how it plays out in CPI. So that should help out a little bit. There is some upside risk, mainly because of the severe weather that we've had in terms of the cold around the country, in terms of snowstorms in places that you never think of snow, and of course, the fires in the Los Angeles area. And that is something where you can see a jump in prices. And here we're just showing a number of factors that do tend to move up in those sort of situations. That said, we don't expect it to have a long-term effect on inflation and should probably correct itself within a few months. But that said, it is something that we continue to watch. In terms of labor pressures, the Fed's in pretty good shape, despite the fact that they've raised interest rates significantly to push down the inflationary pressures. The economy is somewhat immune to that, mainly because a lot of homeowners were able to refinance and lock in very, very low mortgage rates. That provided them an awful lot of excess cash flow on a monthly basis so they could keep spending. So the unemployment rate that you see here on the left-hand side, although it's moved up from the lows, is still at a pretty good level, a level that's considered quite strong in terms of economic growth. What's interesting is how small businesses are looking at the economy. Now, this is important. Small businesses, which we define as 250 workers or less, you see a big jump in terms of what their outlook is going forward. Now, they do about 80% of the hiring, so this is an important thing to follow. But also keep in mind that small business owners do tend to be on the conservative side, so anytime you talk about cutting back on regulations, they're all excited, and you see a big spike like that. How that plays out with labor growth is at least a positive going forward. So we continue to expect to see labor growth at the current pace that we have, stronger than that's coming into the labor force, so that will help keep downward pressure on the unemployment rate. In terms of the deficit, that is a bit of a concern. The new Secretary of Treasury has his 3-3-3 plan, and that is that the deficit should be 3% of GDP, and that GDP growth should be 3%. And that the United States should be producing 3 million more barrels of oil per day. That's a pretty strong task. There's nothing wrong with deficits, but you don't want deficits growing significantly above GDP, because then the total debt gets bigger and bigger. So his goal is to get it at 3%. The chart on the left just shows the deficit. This is the annual change in terms of spending versus revenue. And you can see for some time, it's been greater than that of 3%. And the projection going forward is that it's going to be closer to 6%. So that's going to be a difficult thing to play out. But the strategy is that it should start moving in that direction. In terms of the total debt, you can see that here on the right-hand side. And we're getting to the point where the total amount of debt that we have is greater than that, or will be greater than that, than we had at the end of World War II. Now, from World War II to the 1980s, we were able to bring it down significantly because we were the manufacturer of the world. The GI Bill created workers that had an awful lot of GDP output, and women came into the workforce. A lot of that's not ahead of us this time around. In fact, you have an aging population and a grossly underfunded Medicare, Medicaid, and of course, Social Security program. So there's a lot of work ahead for the administration, but it is something that they're focused on. And that, of course, is a good thing for the financial markets. In terms of the impact, what we've seen so far, this is something that seems to come up every time I give a talk. We now have on the left-hand side, a couple of the key sectors in terms of the spending. Some can be altered, some cannot. The altered ones are the discretionary ones, and that's things like defense spending and non-defense spending. But interest payments are now greater than defense spending, and it's getting to be an awful lot. You're getting up close to $1 trillion per year. And on the right-hand side, you can see what the expectation is that it will get higher than what we had as a peak. Now, keep in mind, back in the 80s and 90s, it was very high because interest rates were very high. But at that time, the deficit was 1/10 the size it is right now. So be thankful for the low level of interest rates, considering how much money the federal government is spending these days. Now, just throw this chart in just to show other countries have been able to reduce their debt to GDP. These are European countries where that's a very important thing for them. And you can see a number of countries, and most of them started it after the pandemic, but they've been able to bring it down. Other countries have been doing it for a longer period of time. Germany, most significant. But keep in mind, the economic histories between the United States and Europe are very different, especially with Germany. In the United States, our greatest economic catastrophe was the Great Depression. We don't want 25% unemployment again. So that's why the federal government is very generous in terms of borrowing money to stimulate economies when it needs to be. Germany, it's the hyperinflation of the Weimar Republic. So they think budget deficits are awful because it's inflationary. Most of Europe thinks that way too. So that's why that's much more focused than it is for us. There are other issues that allow us to borrow more because of the stature of the U.S. Treasuries and the U.S. dollar. But that all said, if the government wants to bring down the deficit, it can. Other countries have clearly shown that they're able to do so. In terms of our outlook going forward, we continue to expect that the Fed will be cutting interest rates 1 to 2 times this year. The Fed has it set at 2 times this year, and you can see the columns on the left-hand side. The Fed funds futures market in terms of its expectation. It's a little bit more aggressive in a few months than at year end, but it all matches up to be about the same neighborhood. And just on the right-hand side, it's just a reminder that sometimes forecasting in the future is very, very difficult, but sometimes it's somewhat easy. The dark blue columns that you see, that's the year-end federal funds rate for each of those calendar years. The lighter blue columns before that, that's the Fed's outlook and the Fed funds futures outlook. As you can see, in 2022, that was very difficult. They were off by a long shot. And the main reason for that is that 2022 inflation, that's when it spiked up to 9.1%, and the Fed was very aggressive at raising interest rates. But you can see in the following 2 years, it got a little bit closer, and the ability to forecast the Fed funds rate has been a little bit more accurate. Our outlook continues to be the same, is that we shouldn't see a great deal of volatility. Yes, there'll be volatility in terms of news coming out of the administration. There'll be volatility in the financial markets. But net, we're dealing with an extremely strong economy that we think will continue to perform well into the next year, into 2026. So a couple of more of the key takeaways on that. The Fed, in terms of its outlook, we don't think that they'll start cutting interest rates until you start seeing the year-over-year change in inflation move down. The last couple of months have actually moved up. The labor growth remains strong, and that'll continue with strong spending going forward. The federal deficit, as I mentioned, is large, but it is something that's being focused on, so that should keep the financial markets relatively calm. And like I said, the Fed will probably hold off until they can see the decline in inflation before they start easing once again. So let me turn it over to Mike right now to give us an update in terms of what's happening in fixed income. Mike?
Excuse me. Wonderful, Paul. Thank you very much. And hello, everyone. So today I'm going to start by taking a look at how rates have moved over the last few months. And so the chart on the left, it simply just traces the Fed funds rate. And we can see that the Fed's easing cycle has started, and rates are now 1% lower. On the right, we graph the 2-year, 10-year, and 30-year Treasury yields. And what we see is that even after a 1% drop in Fed funds, longer-term rates have moved higher. So the 10-year, for example, was at a low of 3.6 in September as the Fed was getting underway, and it reached a high of about 4.8%, and before settling in around 4.5% today. And so the reaction to longer-term yields, it's a little bit counterintuitive. So we tend to think of long-term yields that they should come down when the Fed starts cutting rates. And that's typically the reaction, as rate cuts are usually in response to lower growth and inflation expectations. But this cycle, it's been a little bit different. So as you can see, in September, rates had been coming down after several weak employment reports, and the market was still pricing in this possibility of a recession. And then if we fast forward, recent economic data has shown good underlying strength. And so when you combine this with a more cautious Fed and policy uncertainty from a new administration, this has allowed the curve to shift higher. Now, just as important as watching nominal rates, we also need to take a look at real yields. And so the way to think about real yields, it's the return an investor earns from interest payments after we account for inflation. And so this is important for several reasons. If they're negative, inflation tends to eat away at an investor's return. And just as important, if real yields are too high, this tends to signal financial conditions are tight. And this can slow economic growth, and borrowing tends to become a little bit expensive. And so the chart on this page, it shows the 10-year Treasury real yield. And what we see is that after a period of being negative, and now with the help of moderating inflation, we can see it's now above the long-term average, and it's back to levels that we last experienced before the financial crisis. And so the takeaway here is that for investors, bonds have intrinsic value, and higher real yields do start to suggest a compelling entry point. And just as important, history tells us that the economy can sustain real yields at these levels without choking off growth. And so in addition to an attractive yield environment, it's important to look at the credit environment. So strong credit quality has helped support the markets and returns. And so if we look at corporate credit, despite this higher rate environment, companies are still broadly healthy. In the investment grade space, corporate margins are at all-time highs, leverage remains manageable, and interest coverage is robust at about 11 times. And as you can see from the chart on the left, corporate defaults, which typically occur in the high yield and unrated segments of the market, are currently at about 5.1%, just over that long-term average. And if we look at the table on the right, we show defaults for 2024. And what we see is that approximately half of the default activity last year is concentrated in the healthcare, technology, and services industries. But more importantly, much of this activity is what we would consider distressed exchange. And that's where companies took advantage of strong market demand to refinance debt at new, lower values. And it's not necessarily from filing bankruptcies. So at this point in the cycle, we do see markets fully pricing in strength and credit quality. And while spreads are tight, we do continue to see opportunities and good opportunities for return here. And then when we look at the muni market, it's a similar story here. Quality has been on an improving trend for the last several years. And here we see investment grade issuers experiencing more upgrades than downgrades with the rating agencies. And we do expect to see this continue even as state and local governments transition away from federal support that was received during the pandemic. And even as revenues start to normalize here. Looking at default in municipals, again, virtually all of these will tend to occur in the high yield and non-rated sectors of the market. And as the table on the right shows, defaults tend to make up a small percentage of the overall market. And here again, they tend to be concentrated to a very few sectors, like senior living, retirement, and student housing. And then the chart on the right, it speaks to the relative safety of the asset class. So the red line in this graph, it shows that when looking at the total market, and that's including rated and non-rated bonds, long-term defaults are about 40 basis points within municipals. And that's after removing the impact of Puerto Rico, which has tended to skew the data higher over the last decade. And then turning our attention to supply. So the chart on the left, it looks at issuance in the corporate bond market. And what we see is supply ticking up significantly during the pandemic as issuers took advantage of lower rates, really to shore up balance sheets. And we're starting to see some of this mature now, and we're also starting to see issuers return to the market after higher rates might have kept them on the sidelines for a little while. If we look at the chart on the right, we're looking at the muni market. And here we see a few years of below average supply as issuers postponed capital projects and spent down some of this federal aid. But supply was up sharply last year, and borrowers returned to the market. And so the key takeaway here is for both markets, it's that while supply is expected to come in above long-term averages, we do expect the supply to be easily absorbed by the market. So it's this combination of attractive rates, good credit quality. It's really driven demand. It drove demand significantly last year. We expect it to continue to drive robust demand into this year as well. And then looking at the shape of the curve. So after being deeply inverted, we're now starting to see the curve in its more typical upward slope. And so the gray line here looks at the curve at the end of 2022 as the Fed was aggressively raising rates. And as we can see, short-term yields were a lot higher than long-term yields. And the blue line reflects the current environment where we see a much more normal shape. And this change, it's been driven by this combination of the Fed bringing down short-term rates, while longer-term yields have been pressured a lot due to the strong economy, a little bit of that stickiness in inflation, and then more recently because of policy uncertainty. And so when we think about the curve and when it's inverted, we tend to see this hesitancy to put funds to work. And that's because cash it's so tempting, and these yields people think are going to continue to last for a long time. However, now that we have this positively sloped curve, there's now more incentive to extend maturities, and longer term bonds, they're offering higher yields today. This tends to improve cash flows, and again, it's going to enhance that opportunity for total returns down the road. And so when we look at rates, we do see opportunities across the curve. So for investors that are looking for short-term options for cash, with the Fed slowing the pace of rate cuts, short-term treasuries do continue to offer attractive yields. In the investment grade space, we like return opportunities in the intermediate parts of the curve, and in the high yield markets, we do see opportunities for higher levels of income. And then again, for investors in high tax brackets, the tax benefits of owning municipals does provide meaningful taxable equivalent yields. And so here it's important to remember that, the importance of high starting yields, and what we're seeing today played out last year and continues to play an important part in cushioning rate volatility. And so last year, if we think about the markets, rates were higher year over year, but we still had positive returns across the fixed income market. So it's really about the high starting yields that we're seeing today that we think are very attractive. And then finally, to summarize, we expect to see volatility continue, as markets are reacting to incoming economic data, Fed policy, and this new administration. Attractive nominal and inflation-adjusted yields and strong credit quality are going to help absorb any increase in supply that we might see. And then higher starting yields are benefiting investors and really helping to cushion volatility. So with that, I'll turn it back to you, Charles.
Great, thanks, Mike. So let's run through the equity side and go through a couple of our views on where we think returns are going to be and what feeds that. So first and foremost, we wanted to stress that we do think that equity returns this year are going to moderate. So I went through the strength of the economy and Paul reinforced that. But as a quick recap, if you look at the left-hand side, equity returns are going to be driven by the underlying fundamentals. So that's growth, inflation, the Federal Reserve's path, and corporate profits. Now, also on that left-hand side, you can see that those factors are balanced by high valuations and then very high returns over the past 2 years and simply reversion to the mean. So we have noted that we believe the S&P's potential this year is somewhere around that 6,400 level, with probably a top end being around 6,500. What that implies is about a 6.5% return from today's level. And we need to note that broad indices so far this year in the US are, even after Monday's sell-off, are up about 3%. So generally, our targets assume a high single-digit return this year. And just to reinforce that point, let's just take a look at the average returns going back to 2000. And they've been just under 10%. So we have experienced a substantial outperformance over long-term averages in the post-2008 period, based on quantitative easing and all the stimulus that has come into the market. But we do think that based on the interest rate environment, the Fed's success in reducing the balance sheet, that things have shifted a little bit here. And so to us, this looks more like a pre-2008 growth environment, suggesting somewhat lower returns here than have become the norm that we've been accustomed to over the past 15 years. So I want everybody to keep in mind that this isn't a negative view. We're not saying that stocks are going to drop. This is just a view that is questioning another 25% year after seeing two the past 2 years. We also wanted to share a little bit about the components that go into how we view the return and how we make our estimates. So if we think about the two main factors on this page that I'm showing you that are influencing returns, it's equity valuations, and then it's a metric that we use for risk aversion. So we've discussed a couple of times now how equity valuations are high, and we've discussed the reasons for that, and we need to respect those levels. If we look at risk aversion, it's a contrarian signal. What that means is that when it goes up, it's good for forward returns. When it goes down, it isn't. So right now it's moving a little bit higher, which is a sign of potential positive returns moving forward. And then the other items that we take into account are interest rates, government spending, so the fiscal side of things, the existing trend in the market, and then overall financial conditions. So if you combine all these together, you look at a lot of the arrows that are going straight up, they really create a neutral signal. So that again reinforces the concept that we think returns are going to hit long-term averages this year. And just to go one step further on this, I know this is a little bit of a kind of intimidating looking slide, but I'll walk you through it. We just wanted to dive a little bit deeper. So I focused here on the valuation component and the risk aversion component. So if you look at the left side, it's valuation. The right side is this risk aversion component. And what the top charts show is the existing levels, and the bottom charts show the relationships. And we do this for all the factors that we look at. So if you take a look at those light blue lines in the bottom charts, do you see how each line on the left moves down and the line on the right moves up? This represents the general relationship between the movement in these items and the resulting forward returns. So you can see on the left-hand side and the left bottom, as valuations move higher, those forward returns tend to be a little bit lower. As risk aversion moves higher on the right-hand side, forward returns tend to be a bit higher. But it's important to note here that there are a lot of observations. So if you look at all the blue dots, they don't necessarily follow these trends, which is why you can see markets rise even with high valuations. And of course, we've seen that lately, or returns can still be lower if risk aversion starts to climb a little bit higher. But overall, this is really what helps us understand how the market might move going forward. And I've got two more topics to talk about today. So the first, I just want to talk about technology and try to position that and just kind of illustrate how we're thinking about it. And then I want to go through small caps. But if we take a look at this slide here, we're just illustrating how much technology has outpaced the rest of the US equity market over the past 10 years. So it's been tremendous, climbing nearly 400% over the S&P 500 and then the S&P 500 excluding just information technology. And there are four components that we think are really important as we move forward. So we do think that the momentum in technology remains intact. I mentioned the expectations going forward are for those earnings estimates to really moderate towards 15%. But the pace of appreciation in these names is likely to moderate. So this gets back to the trends we've been talking about in terms of the broadening in the economy and how important that is for continued returns. So we should expect that performance within these sectors should be closer to broader market indexes as that valuation premium starts to normalize again, as we have a little bit lower earnings compared to the high numbers that we've seen. So earnings growth relative to these other sectors should shrink, and then spending will slow a little bit in the technology sector. And what I really like, and I can't sort of claim making this up, this came from Joe Handelman, our new head of equity, but technology's transformation is really moving from a disruptor, so just a technology impact, to an enabler, so giving other companies the power of the technology that's being developed. So that's good for broadening, and we're going to see tech-enabled companies in most of the other sectors, rather than pure play tech firms, start to experience some of that influence. And then just going back to the same thing we showed you with the S&P 500, there will be a normalization in technology returns. So if we go back to 2011, we can see how they've moved over time, and that average is going to come back into that 10 to 15% type of range. So we don't expect to see these large moves going forward in the tech sector as we think about what's going to happen here in 2025. And then the last slide, really just as a reminder, I wanted to come into sort of the small cap side of things and just reinforce that it has become more attractive. So some of the reasons for that, if you look at the left-hand side, it's US homegrown revenue. So it's domestic US revenues. And it has a much higher percentage of that relative to other indices. And then if we think about the valuation comparison, this is in the top right, it's still really cheap relative to the S&P 500. And we have to take this with a grain of salt. And I've talked about valuations not being the only driver, but relative to optimism and a lot of the impacts that we're going to see, we think small caps are going to do pretty well. And the other component here is sector exposure. So if you go down to the bottom right chart, you can see how financials, industrials, consumer discretionary, all of that has a bigger weight overall in mid caps relative to the S&P 500. And of course, the information technology exposure is nearly 20% less in small caps. So it allows us to position well for this continued broadening. So that does it for our prepared remarks. I think a quick reminder, just if you have a question, you can submit it in the Q&A console. And we certainly had quite a few come in already. So I'm going to go over to Mike first on the rate side, because certainly with everything impacting us from the administration, the executive orders, that's been a huge topic. So Mike, the first question is, with the Fed pausing, so turning a little bit more hawkish here and not cutting as aggressively, does it still make sense to extend duration?
Great, thanks, Charles. And yeah, we do think that, for longer term investors, it does continue to make sense to add duration. And really how far out the curve you go is going to be client specific and really dependent on goals and needs and expectations for those funds. But, our reasoning here is for one, the Fed is still expected to lower rates. So it's just that glide path that might be a little bit longer. So, when we think about it for very short-term investors, we can continue to enjoy those really attractive yields that we're seeing in T-bills. But for investors with a longer horizon, modestly extending maturities, it's going to help to lock in some of those higher yields we talked about, further out the curve. And, over time, as we continue to move to this more normalized rate environment, we would expect those longer duration portfolios to start to outperform shorter duration portfolios. So, the shape of the curve really does tell us it is time to move out a little bit, even with the Fed, on hold.
Great, thanks, Mike. And I'll catch you with one more. So we all know the devastating impacts that have been happening out in LA with the wildfires. So can you just give us a quick overview of the impact to the California muni market from the fires?
Yeah, that's a good question, and thanks for asking. So we have seen, some volatility in the muni market, as a result of the fire. So, select issuers, we've seen some spread widening in some of the local credits within the region. But, when we look at the market, the full impact and the impact to municipal bond credit quality, it's not going to be known for some time. But what we do expect is for these credits to remain resilient and with a low risk of payment difficulty. This is especially true, for LA area issuers, because they tend to benefit from this diverse tax base and what we call strong pre-event liquidity and financial flexibility. So, we do expect state assistance, and FEMA aid is going to play an important part in the recovery and rebuilding process over the next few years. And then more importantly, I think, when we tend to see is municipal bond issuers, they have a really strong repayment history following natural disaster. So any disruptions that tend to occur, they tend to be isolated and really amongst the smallest issuers. So, we continue to think, credit quality will be fine within the impacted areas.
Great. Thanks a lot, Mike. So I want to move on to Paul on the econ side. And this is a question that's come in from multiple listeners and been a focus of attention across the market. But why do you think that the president has changed course and decreased the talk around tariffs on China and increased the probability, has just a higher focus on some of the high tariffs that could go into place for Canada and Mexico?
Yeah, that's a good question, because I must admit it's a bit of a head scratcher for me. Throughout the entire campaign, we heard about extremely high tariffs on China and some talk with Mexico and Canada, but not as severe. He does have for frustration with Mexico in terms of immigration and in terms of drugs coming over the border. Canada is a little different. We have a positive trade surplus with Canada when you exclude energy. We get 60% of our oil from Canada. If you're in the Rocky Mountain states or the Midwest, this is where a lot of your oil-based products are coming from. So there's not much of an alternative. And if you're south of Quebec, we get an awful lot of electricity from Hydro-Quebec. So that one is surprising. But what we do know about the president is that he likes to use tariffs as a bargaining chip. So maybe that's what he's doing. He's getting ready for the next round of talks of free trade between Mexico and Canada, what used to be called NAFTA. And, maybe a little bit soft on China might play into what you were talking about in terms of helping to combat against Russia for oil prices. I don't know. But my guess is that he's playing 2 or 3 places ahead of those ideas in terms of what he's hoping to negotiate in terms of trade or in terms of geopolitical issues. So that's my guess, is it's more of putting something out there to use as a negotiating tool for something else that he might want.
Great. Thanks a lot, Paul. So I've been getting a lot of questions from clients generally when I've been out there on the road, just on the commodities and precious metals front. And a few more of those came in today. So let's talk about some of the year-to-date moves there. I think the run so far has been pretty strong with concern about prices, the outcome of tariff policy. The commodity space is up about 4%. And so we've seen the strongest run so far in heating oil and natural gas. I think part of this we have to acknowledge is seasonal. It is the wintertime, so that demand tends to go up. We also have energy demand that's growing substantially with data center growth, and that particularly impacts the natural gas space. And so that's part of the reason why I think that's leading the commodities market. And at this point with base commodities, again, going back to it, a lot of it is seasonal. I do think there's some component related to the administration. But my thinking on that policy mix, again, we've talked about it a lot, is just that we think it's going to result in sort of prices staying where they are, but it's not going to lead to runaway inflation. So we think this run is a bit premature on the commodities front. If we move to the metals front, and we discussed this as well pretty frequently, but we think that gold's rallying not because inflation is high or there's a flight to safety. We think it has more to do with central bank buying, and that does continue a little bit. So it has hit an all-time high actually today. But a lot of the momentum trades, so players we see come into the markets that are speculating, are hitting a lot of their max position sizes. So I think the technicals are going to start to shift a little bit. So we do believe that this rally in gold is pretty extended at this point, and we aren't recommending it in any portfolios. The other question that I saw come in a little bit was earnings season and just what's happening with corporate profits. So we've painted a picture of that being very positive, but what are the actual numbers? So I think I'd say for Q4, so far, so good. So I think the bottom line here, consumer spending is really strong. That's driving corporate profits. And the latest growth numbers after about 112 companies reporting are coming in right around 8.5%. And that's versus expectations of about 7.3. And we're also seeing some signs here that small businesses are doing very well. And that supports the notion that earnings are broadening out in our trade and positioning in small caps. And this is also evidenced in sort of the equal weight S&P 500. And that's where every company in that index is weighted the same. And then tech is coming in okay too. We've had upbeat outlooks from Tesla and Meta. We've got Apple coming out today after the market closed, so we will be watching that very closely. So I do think we're in very good shape right now as we continue to move through the season. And then if we talk about 2025, that continues to look in good shape as well with double-digit expectations. So Paul, I'm going to have one more question for you just on the economic side, and then we'll wrap things up. So you can give us your best 1-minute answer. But you've painted a great story of a solid economy. And so what are the things that keep you worrying at night about growth and about the economic backdrop?
Yeah, the economy is rock solid. And like I said, household wealth is very high. Leverage is very, very low. Unemployment rates are very low. Income is strong. The risk continues to be geopolitical risk. There is some good news out there, but, tariffs are one of those things that tend to make people angry. There's a reason why the world pretty much got rid of them after World War II. They believe that having very low tariffs and a lot of trade between countries will keep much more harmony in the world. And using tariffs as a tool, and we've seen effectively as a tool with Colombia, it can agitate things. So that does concern me.
Great. Thanks a lot, Paul. So thank you all for joining us today. A brief survey is going to pop up in your console, so please share your feedback. And we'd love to hear suggestions about future topics. That always makes it a little bit easier for us to prepare the content. And then a replay of this session will be available for you within 24 hours, and you will receive an email letting you know how to access that. So from there, have a great day, everyone. Thanks for joining.